Start today's market talk. Uh, what I was referring right now, or the conversation we were having till now, is that only if everyone is waiting for a correction, so any decline may be very brief and untradeable because there's a lot of money which is waiting to come in, and then so the decline becomes very difficult to understand as to till what level it will stop. So it's not that easy to wait for a decline or when to put in your money because a lot of money is waiting on the sidelines. And if you see, all major markets are above their levels which were at the beginning of the year. So this is nothing, right? If you see Nifty, it has moved just 5-6% only this year. Nasdaq is up 30%. Japanese market is up say around 20%. And what people are thinking? People are thinking is that inflation is on the way down, rates are near their peaks, so subsequently the cost of money will go down, and only the markets can go up. So what is being assumed in the US and all advanced economies is that high inflation is now over, and after this it will inflation will go down to their reasonable levels without triggering a recession, because the if you see the last GDP numbers of US at 2% GDP growth, that is very good with the present interest rate scenario, with all the problems they had with banking and all those issues. And the US had a stress test of banking sector also recently, and that also went off well. So, what JP Morgan is saying is that it is too good to be true. But who can fight the markets, right? So, every investor who is waiting for a decline for shifting assets to equities from some other place or from debt or other places, uh, the wait may be very long. So everyone who was anticipating that there would be a recession and there would be a bear markets will correct, has been proved wrong. So one view could be that it doesn't work to time the market. So those SIP guys who are putting money every month regularly are the actual winners. So as the setup as I see it, markets are rallying because there are great expectations for rest of the year. As I brought out, it is the exponential growth in liquidity which is now driving the asset prices. If there are reports which says the liquidity levels are the same as what it was before the US started raising the interest rates. And in addition, lower commodity prices are providing resilience to all economies, in particularly ones like India, which are commodity dependent. For Indian market, there is a CLSA note which says that valuation is very rich, margins and ROEs are eroding, and EPS estimates are unrealistic. Let's see how whether they are right or wrong. Right now, the market is not showing that. Now let's talk about HDFC Bank, which was the one of the stocks which moved the markets last week. It can positively surprise both in terms of growth as well as profitability, which can lead to valuation re-rating. The reason is that all the subsidiaries of HDFC, which were part of HDFC's valuation as part of some of the parts, will now come into the valuations of HDFC Bank. So there would be a re-rating because of change in SOTP, some of the parts valuation. So, what merger will lead to is a better loan book, much more diversified, with high share of mortgages. Mortgages is basically home loans, which are for longer duration and more secure. And there would be a lot of cross-selling opportunities. The deposit growth has been good for HDFC Bank, and you must have seen around yourself. They are opening so many branches just to mop up more deposits. The problems or the concerns are that there would be CRR and SLR requirements, which hopefully they should be able to meet. And if they are able to meet the priority sector lending norms, then it will be a good future for them. So the sum of the part valuation, which I have seen in one of the estimates, is around 2150. So at the present value, at the current market price, it is presently at twice price to book, which is pretty low. So there could be a valuation re-rating of HDFC Bank, and which is the one which is driving the indexes. What is going to happen is post this merger, the HDFC Bank and RIL Reliance will have huge weightage. So you can just move Bank Nifty oblique Nifty by just moving these two stocks. Okay, let's talk about BDL. Uh, 2024 would be better for BDL as per uh, certain comments from some of the people who are handling them, because the key is execution. Considering that the company is sitting on a strong order book of close to around 20,000 crore, which is 8 times its annual revenue. So there is a revenue visibility for at least next 5 to 8 years. The only problem which was there in their results of Q4 FY24 was their execution. Now their order flows are good. They are guided for a revenue of 3,200 crore in next financial year, which is up around 28% from the last year. But their performance has been poor and execution has been slow in the March quarter, which had a negative impact. So at presently, it is valued at 25 P of FY25 expected earnings, and in case they are able to execute well, then they should again get re-rated. In Q4 FY23, because of low execution or poor execution, their margins also dropped. But in terms of all the PSUs, especially the defense ones, you can't see them quarter results. You have to see them over a period of time. Hence, all these dips are a good opportunity to enter these stocks. Now, talking about Ultratech Cement, they are expanding their capacity by around 19% from the current 135 million tons per annum to 160 million tons per annum, which will get operational in phases from this year to FY26. So, at a growth rate of 10 to 11%, which they have achieved over last 10 years, vis-a-vis industry's average growth rate of 5%, they are gaining market share to the tune. Right now, their market share is around 25-26%. So, in my view, Ultratech Cement has a bright future and a stock to hold. Now, the interesting part of the last month or so was that large number of promoters and private equity exited their holdings in June to the extent of roughly $2 billion of block deals. In any other time, this would have led to an correction. But all these clean out trades, despite their taking place, the stock prices reacted favorably. We saw in terms of HDFC, AMC, Delivery, Go Fashion, where the block of 10.8% was launched on Sunday and got absorbed on Monday morning. So Indian markets have absorbed all the selling, which shows the depth of capital markets. It is positive that large PE players are getting exits at good prices without price damage. So it will lead to more people putting in larger stakes in the market moment they get liquidity.
Tarun, this could be because of the euphoria in the market. Because what I have noticed is like Bank of Baroda became ex-dividend. It was trading around 190. Even after becoming ex-dividend, it is still trading the same. The dividend was 5.5 rupees. So I think overall all this thing is happening because of general euphoria in the market.
Yes, sir. You're right, sir. Uh, we'll discuss this slightly in detail later. The point here is, sir, that what happens is that if I am able to get liquidity, then only I'll invest in a company where, like initial investors, those who had put in money in the IPOs, etc., after say 1 year or 2 years, once they have achieved their targets, they are looking for shifting the money to some new idea. If they are not able to get liquidity, it will stop somebody else from getting the money into the markets. Now, in case there are large good liquidity, they are able to sell off their stakes to
Yes.
other people.
Yes.
Then it is very positive for the market.
Yeah. Correct.
And you see, normal times, sir, if a promoter sells, so it is taken used to be taken as negative. But here we saw in case like for Timken, the promoter sold and the stock has not corrected much. And for HDFC AMC, this actually that overhang of stake sale is over, and the stock is now doing much better. So that was the only point. Okay, let's discuss about Sona BLW Precision Forging Limited in detail. Interestingly, this is a multi-product, multi-geography auto ancillary company which is into manufacturing products like differential gears, which are 32% of their revenue. I think they have a market share of around 7 to 8% in the world in differential gears. Differential assemblies, 23%, starter motors for hybrids and internal combustion engines, 21% and 15% respectively, traction motors for two-wheeler electric vehicles, 4%, and others. So they are not restricted to one geography, one product like that. So even if one product doesn't work, something else works. Exports are around 71%, with US and Europe being the largest markets, 43% and 20% of the total exports, respectively. EV electric vehicle opportunity provides the moat for this company as 77% of the current order book of 215 billion. To convert into crore, you have to just multiply it by 100. So that means 21,500 crores belongs to electric vehicles only. So we can anticipate a revenue CAGR of roughly 35 to 40%, and similarly for profit after tax, respectively, and good return ratio of 25%. That is ROE of approximately 25%. Now, the problem with this stock only was valuation. Initially, it went up to 800 odd, and I'll show you subsequently the valuation have corrected. And there are various reports and various estimates of the price for this stock, and it all depends. I went through two or three reports. The difference is on estimated earnings for this year and the next year. So, based on estimates of earnings, people have given their targets. Okay, now there are two important points which I wanted to highlight here. One was, let's assume this year the earning per share is 6.8, right? So, assuming next year is 10 and FY25 is 14, right? So, it becomes reasonable at FY25 expected earnings to around 40 times, 35 to 40 times at present price. And the key issue here is that the Blackstone, which was earlier a major investor in this company, did a clean out trade in the last quarter. So that overhang is over. So that was one of the major issues which led to price destruction. So that overhang is over here. Now, seeing the financials, if you see the financials are roughly improving. This is revenue. Revenue growth is good, 29 to 30% expected growth. Then EBITDA growth is also good. Operating profits are growing at around 27-28%. Though it have declined from what they were, but as the company size grows, you can't grow at the same level. The PAT margins, profit after tax, again is showing an upward trend. The ROE and ROCE are also showing upward trend. So it's all positive only. Now, the point here is that they generate 47% of their revenue from EVs and micro hybrid oblique hybrids. And they have an order book, as we have discussed. Most of the order book is coming from electric vehicles. What it has done is it has leveraged its forging process to introduce new products such as differential assembly, spool gear, spiral bevel gears, independent suspension, e-axle, and electronically locking differentials. So the legacy product is basically, as I mentioned earlier, differential gears, where it has a global market share of 7.2%, which has improved from 4.5% in 2019. So in India only, it is a leader in differential gears with a market share ranging from 50 to 80% in all types of vehicles. Now, what the differential gear does is, I think, can be read, but basically it manages the speed of various tires separately, matlab various wheels separately in a vehicle. So that is the basic task. And what I have found is with electrical vehicle introduction and parts being made and all those issues, so they will realize higher prices for all parts they make, because all the all the industrial part is becoming more complicated than conventional parts. Hence their realization per vehicle will improve. Now, seeing the charts, if you see, the price went to approximately 800 odd in end 2021, and after that it declined, and then it is showing a upward trend. The low was around 400, so it is just above the 50-day moving average of around 508, and the 200 DMA is at around 490. So in my view, and it has been rebounding from this level 505, 508, so many times now. So this is a good level to accumulate this stock if you have a long term horizon. But rest, in case there are dips or the results are bad as per estimation, then it may go down. But this is a good support for the stock. Okay, now we will discuss about the put call ratio. Before that, I just wanted to show what is an option chain. Option chain is list of all available option contracts of an underlying security. Now this is available on the NSE site, right? And it looks like this. This is for Nifty 6 July expiry, and you can see all the strike prices for calls and puts on both sides as we go down on this. So you can just see this on the NSE website. Now, it lists the option contracts for indices as well as stocks. You can select the underlying and the expiry to view all strikes, or you could select a particular strike price to view all expiries. It allows us to track a wide range of option data, premium, implied volatility, open interest, and volumes for both call and put options. I'll just show it to you. So all these details, open interest, change in open interest, volumes, implied volatility, last traded price, change, bid quantity, bid, ask quantity, everything is listed for both calls and puts. So with the open interest which is available here from the option chain, one can calculate the put call ratio, also called PCR. So it's very simple. Put call ratio is open interest of put options divided by open interest of call options. At present, the last one, as on date, it is 1.64. Now we'll see what is the implications of this 1.64. How we have calculated, this is where it is reflected. For 6 July expiry, for Nifty, the open interest of calls is 1421,954, and for puts is 2332,904. So you can see there are more interest in puts than calls, right? So now we will see how we interpret this. PCR put call ratio indicates the number of outstanding contracts in put options related to the number of outstanding contracts in call options. For example, PCR of 1.64 indicates that there is 1.64 times more interest in put options than in call options for Nifty 6 July expiry. Now, we can draw inferences on the general mood of market from this. First and foremost, we have to remember that this market is option sellers driven. So open interest in an option is driven by how many sellers find it worthwhile to sell the options. So here we see that put open interest is higher than the call option open interest. It indicates that there are more put sellers than call sellers. Now, if we sell call options, then we are bearish. We expect the market to go down, and we sell put options, then we are bullish. So it indicates that the if the PCR is high and there are more put sellers, that means they are bullish on the market. When PCR is high and there are more put sellers than call sellers, that is the general sentiment is bullish. Similarly, when PCR is low, the trend is bearish. So this is the basic understanding of put call ratio. Now let's see how we interpret it. If you see, if it is above 1.7, it indicates that there is too much of euphoria and there is likelihood of a bearish reversal. From 1 to 1.7, it's bullish. From at 1, it is neutral. Zero point 0.6 to 1 is roughly bearish, where there are more call sellers than put sellers. And points below zero point 0.6, there is a reversal which is coming. So these are the basic numbers you can see to analyze the trend. But high put call ratio also indicates complacency and a possible trend reversal around the corner. For example, if PCR is higher than say 1.7, it indicates a possible complacency among the put sellers. So everybody is writing puts without thinking, right? So when such complacency sets in, a root shock is likely. So as we seen presently for the next week expiry, the put call ratio is 1.64, so one has to be slightly careful. It implies that a bearish reversal would be close at hand. Similarly, when PCR is too low as a thumb rule below zero point 0.6 or around those levels, it is possible that a bullish reversal is on the way. Now, the point is you have to see the for the complete option chain the put call ratio. Strike wise option open interest cannot be used to make views on the market. They can only help identify strikes with sufficient liquidity to absorb our trades without significant impact cost. Impact cost is in case there is lack of liquidity. So if you take a trade and there is you can't close that trade, then there is no point. So you will have an impact cost because you will have to sell it at a lower price in case you are desperate. The point to note is PCR is quite dynamic. It changes regularly, and it is one of the many indicators of the trend or the mood of the stock market. It is not the only trend, but it is one of the trend to be kept in mind. Now, for stocks, you can't. This is good for index, but for stocks, the point is stock options are delivery settled, while index options are cash settled. Hence, for so you will find that the call writers on a stock may not be necessarily bearish on a stock. They could instead be employing a covered call hedging strategy while holding the underlying assets. So this is corroborated by the fact that you may check it out for stock options, irrespective of the trend or the mood in the stock, call open interest is always higher than the put open interest. So you can't uh, uh, correlate this issue with the mood of the market for stocks. The call open interest is always higher for stocks vis-a-vis indexes. So for views on stocks, it is better to track the futures open interest instead of options open interest, which can be seen from NSE website. And if you see, it's very simple. When the prices go up, open interest goes up for futures. it indicates there is a long build up. So people are going long or buying the futures. When the price goes down and the open interest is down, it indicates there is a long unwinding which is taking place. People are squaring off their long positions. If the price goes down and the open interest is up, but the number of contracts have increased and the price is going down, it indicates there is a short buildup. People are creating short positions on stocks. And if the price goes up, but the open interest goes down, that means there is short covering on the stock which is taking place, which is leading to prices going up. And, but the open interest, that is the positions being closed. So this is a simple way to analyze the open interest for indexes and stocks. I have finished.